Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Oh, g'day, how you going? Hope you're well. Hope you're enjoying the Smart Property Investment Show. It's a real privilege for me to actually deliver this, and now so more than ever before in a sort of distributed, disrupted world with everyone working from home. It's good to get onto the airwaves and channel into people irrespective of where they listen to the podcast. And I think some of those habits have changed quite a lot. You know, a lot of the research we've done, both anecdotal and through some surveying, is that a lot of people like to listen to this podcast, whether it's at the gym, walking their dog, commuting to work. And a lot of those habits and behaviours have changed. I think a lot of people are walking their dog still. It's one way to get out of the house. But, the way people are engaging podcasts is evolving. And, in hindsight and, much like investing in property, it's always good to be prepared. And we made the strategic shift to this particular medium many, many years ago. And hence the reason why now today, the Smart Property Investment Show is one of the most popular business podcasts in Australia. So I get a real kick out of delivering it. And it's nice to know that I am helping and assisting people through this journey of property investment and how we all sort of are moving towards wealth creation. But we'll keep at this. It's important for us to keep doing it. The way in which people consume media changes, but the basic premise and overall value is consistent, and that is for us, and as a tagline for our organisation, be better informed. So that's our guiding light, that's our beacon, that's our mantra, and that's what we'll follow as we go down this path with smart property investment into the future. And thank you so much for joining us on this podcast. It is a huge community now, and I sometimes need to pinch myself when I think of the responsibility for me to get it right, considering there's well over 100,000 people tune into this thing every single month. So if I don't always get it right, my apologies, but that's just the way I choose to operate, and I'm very reflective, and I'm always looking for ways in which to do a better job. So please get connected and in touch if you think there's anything we can do, whether it's small little things or something more strategic. Editor at smartpropertyinvestment.com.au is where you need to go. But outside of that, you can have confidence that we're pushing ahead here, and our commitment to property investment is only stronger today than what it was at any given time. That's what we're doing, and we're very fortunate here in that we're highly connected and engaged right across the property investment sector. The fact that we can pick up the phone and talk to anyone in Australia about property is a huge advantage, but that doesn't mean that you don't have that also. Part of my job is to make sure that you are in tune and connected with my journey through property investment, all the discussions I have, and I get to share them live on this podcast. So joining me today is one of those stakeholders that we've had a long relationship with, someone I turn to often as a source of pragmatic knowledge and understanding of the property market, and someone that doesn't get taken away or blow things out of proportion. Very stable, good set of hands. He's been through many, many different markets, this just being one of them. Steve Waters, he's the director of the Right Property Group. He's also my buyer's agent. He's part of the team who has supported me build out a portfolio at smartpropertyinvestment.com.au. And stand by, we're going to do a property update at a point in time. I'm right in the middle now of just recalibrating all our mortgages and understanding where we're at. So we'll have a chat about that at a point in time. But I've asked Steve to come to the studio, and we're actually in the studio. So you'll notice that this is not a stream through the internet, and maybe the quality is much better when we do it live in the studio. I do like to do it in person with people, but I can rest assured that myself and Steve are definitely social distancing. We're standing about 4 meters apart from each other. I don't want to go near this bloke. But he was in the area, and he swung by amongst many of the stuff that he's up to have a chat with us, and we're going to talk all things market, get a bit of a sense on and perspective towards some of the rhetoric coming out of the rating agencies and some of the other economic forecasters. And importantly, and this is somewhere I've always lent on Steve and his team at the Right Property Group, just getting a ground truth and how that ground truth, and I'm not going to claim that term, I think it's his, but how that ground truth actually interprets or has a relationship with the data that we're seeing right now. So a long-winded introduction, Steve, but how you going, mate? I haven't seen you for a long time.
It's been a couple of months now, hasn't it?
Crazy.
It's an amazing time that we live in, but thanks to technology, we can still function quite normally. And who knows, maybe that's the new norm.
It is the new norm, I think. And we actually have our producer is not sitting in the studio with us. He's at home, working from home. tuning into this right now, and he's got control of the computers here, and can do whatever he wants to do on dials and buttons and all this sort of stuff. So James, shout out to you. I know you can hear us right now, and we're continuing business as usual. And to my original point, we made a strategic shift many years ago into this podcasting format, digital format, live streaming, stepping away from the traditional print publishing, and what you can achieve through these mediums versus print publishing is just dwarfs it. So I think we lament now that there is from what I understand, no more print property investment products on the market. But do not be concerned. This has been the new normal for many, many years, podcasting, and being able to inject a bit of flavour, personality. It can be a lot more raw and authentic in this sort of stuff. You don't need to have a nice polished piece with no typos and stuff in it, right? You get to make mistakes on podcasts.
I wouldn't imagine there'd be too many typos from you, mate, being editor at large that you are.
Yeah, I do a lot of typos. But Steve, this is not your first rodeo. You've been through market disruptions before.
Several, dozens
actually. Of them. And when you think of this is a health pandemic, which has turned into an economic crisis and psychological crisis. And we'll have a chat a little bit about that towards the back end of the podcast. But this is a global pandemic. It's hit Australia hard, but to be fair, not as hard as maybe some other places. So again, I think Australia's going to do what it did during the GFC and come through that reasonably much better off than other nations. But Australia's impacted in a whole bunch of different ways. There's different stories to different states based on how those state governments have reacted to it, and that's translated down into what's happening at local areas. But there's not one property market in Australia. There's property markets everywhere. So what I want to do is get a sense from you, Steve, based on experience and a number of market cycles you've been to. So there is a top-line market cycle. This is going to be one of them. GFC was another one. There was one in between that when last year's federal election. Has been national market cycles, but there's market cycles in every state. There's market cycles in every area. So realistically, you've probably seen maybe hundreds of market cycles when most people get carried away with the national narrative. So give me some sense of this cycle. Like, what's going on, mate? It's a big question, but
it is. And I think let's start with saying that there's over 15,000 suburbs in Australia, and potentially each one of those is its own unique little cycle from one time to another. But you did mention something quite interesting earlier on in your introduction in regards to the podcast, and now it's the new medium for getting information out and people educating themselves and what have you, as opposed to the traditional print style papers, magazines, and what have you. And that really does play into the fact that the information that we're receiving today is vastly different from perhaps the GFC, which is what a lot of people are drawing comparison to in terms of all commodities, stocks and property and the economy at large. Back then, it was a written piece, and it was very delicately written.
Yeah, it's crafted.
Yeah, that's the way. And there was no back and forth. There was no questions other than a few little comments at the back of the newspaper. Maybe there was radio, of course, as well. But with today, information is instant. There are far more people that are willing and can give their opinion on what is happening to the economy. And so what that does as a direct result is essentially you have three camps. You have the people that are just completely negative, and there are some media outlets that perpetuate that. We won't sort of mention who they are. And then there is potentially the other side of the coin where people are extremely buoyant and just think that this will have some sort of V-shaped recovery. And then there's somewhere in the middle, with some sensibility around it, and people are really trying to, I suppose, forge out a relevant opinion, and they're reliant upon the different agencies and media coverage to be able to help them make that decision. But where the market is completely different today, in my opinion, is let's go back to the GFC. That's probably the most relevant, biggest handbrake or scenario that we've had in recent years, other than the whole APRA handbrake, of course. And people want to draw this comparison between the GFC and today, and it's not there, especially when we're talking around property. There's some major, major differences as to why the market today in some areas, and I emphasise some, really haven't seen too much disruption, for want of a better word. Back then, the cost of money was circa 7%. Today, it's 3 to 4%. Big difference. Back then, there wasn't the amounts of initial and immediate stimulus as there is today, JobKeeper, JobSeeker and the like. And then back then, there wasn't a 6-month mortgage moratorium as there is today. There probably wasn't as many vested, interested parties all coming together at the one time across the world, trying to stem this pandemic, whether it be from a physical point of view, a psychological, or of course a medical point of view. And so what that does to today's market is it's really, for mine, broken it down into several sub-markets. We have the top end of town, we have the affordable corridors, and potentially we have regional, if you really want to just break it down into three markets. How they're performing today is largely reliant upon clearly mobility, but also what those localised economies are doing, or who owns those properties and how their job prospects are in terms of their income. So as we roll forward, or as we roll out, I would expect that there will be some markets that will take some time to recover because of the industries that they're closely tied to. And I think others will potentially have a growth, not spurt, because that conjures up the image of this large incline in price, but they'll continue to go okay until there's some perpetuation and mobility, and then you'll start to see the recovery gain legs. But to have a recovery, there has to be a decline in prices. And once again, there's a lot of people that are talking about this V-curve recovery. And to have a V-curve recovery, you need to have an inverted V decline in prices. And we're just not seeing that at this point in time.
So that's an interesting point. So certain sources will be painting a picture of doom and gloom, and you have some of these forecasters or economists, demographers, whatever you want to call them, who have popped back up and gone, yes, I've been telling you for 20 years that you're going to see a 40% drop in housing prices. This is the time. Aren't I smart? I've told you so and no one listened to me, but aren't I right?
It's like the weather forecasters predicting rain during a drought.
Yeah,
they keep saying it'll come true.
It'll come true, right? And we all know who we're talking about, the particular person. On the other side, you have certain segments, and a lot of this propagated in social media, and I'm going to call it probably people who probably shouldn't have the opinion that they do in terms of shaping how people are framing property investment, saying, this is the best time ever. Go and do this. You've never been given a better opportunity to do whatever and invest in property. This is when you're going to become a bazillionaire, right? And there's a couple of people out there doing that sort of stuff. They are not part of the smart property investment ecosystem. They see the world very differently to the self and the people that we like to work with, including yourself, Steve, who are very balanced in their views. So you have them out there, and then you got the middle of the road. And this is the informed and educated, sophisticated people who know that it's not horses for courses, not the same area where you go, and they won't get pulled in particular version of what they think the reality is. So you're on the ground, this whole concept of ground truth, which means what is actually happening on the streets. Where do you sit within all of this? Are we going to see super duper price growths? Are we going to see super duper negative price growth? Or are we just going to see, because of the nature of real estate and the nature of what manipulates prices is supply and demand, stock is down, listings are down, but you still have people in the market. So is there just a natural equilibrium, which means that prices will remain stable, or is there going to be a huge drop?
I think there'll be both,
okay,
is the short answer. There are some areas within the property sector which I do think will suffer, and some will suffer greatly. And if I draw experience out of one of the properties in my portfolio, which I have spoken about before, the off-the-plan service department by the water holiday let area, those types of properties will suffer. In fact, they already are. So to give you the example of mine, there is 0 tenants in that whole complex because it's based on tourism, it's based on travel and mobility. And so for how many months going forward will I have 0 tenant, and that will greatly affect the value of that property. I would also delicately guesstimate, as I look into the murky crystal ball, that there'll be some higher end properties too that may suffer because in some way, shape or form, the owners, the dwellers or the tenants are tied to the stock market or any derivative of. And so you might start to see those types of properties suffer. But alternatively, they also, 10% growth of a $2 million property is far more attractive at that point in time than 10% growth of a $500,000 property. And people tend to always remember the good times. I think the affordable corridors will continue to hold their ground. And I think that some of the regional areas, the major regional areas, may perform well over the next couple of years as people have this aha moment around technology, as we talked about earlier on, a greener, cleaner lifestyle, and potentially portions of the population will leave the highly dense areas and look for these larger areas. And so some of those major regional areas that do have the right infrastructure in place and the fundamentals, such as their economy drivers, may perform okay over the coming years. But from a very even point of view, what we're seeing today from a ground truth perspective is that we have data telling us from some of the outlets that we will see a 30% or 20 to 30% decrease in price, and I'm not seeing that, and I'll have a caveat to that in a minute. We are seeing a massive reduction in the amount of stock on market. So that's the people that are selling their properties. And there's still the demand there. There are still investors who are quite buoyant and want to get into the market. There are your first homeowners who are taking advantage of all the government grants and schemes that they can. And this all revolves around their security within their jobs, of course. You have the upsizers, the downsizers, and you have the larger developers who are looking to land banks. So all these people are still in the market, be it that the temper has subdued somewhat, but certainly nowhere near the reduction on properties on market. So it comes back to, as of today, a supply and demand issue. So how that rolls out, we don't know. If this goes for longer than 6 months in terms of mobility and the mortgage moratoriums, well, then it might be a different story. But what we've achieved in the last 30 days as a nation is, gives you a degree of confidence where we'll be in the next 30 days.
I completely agree with you. And there is segments of Australia who, irrespective of what our political parties do, and wherever you sit on the spectrum is irrelevant, who are always going to throw rocks at it.
That's their job.
That's their job. And there's portions of the Australian community who feel as though the government doesn't add any value at all. Now, success leaves clues, right? Now, let's look at what we've been able to achieve. And my political point of view is irrelevant in this conversation. But when you look at the Commonwealth, the Morrison government, when you look at the benchmark of how other nations have fared, we've done pretty well. His approval ratings are through the roof, right, compared to where he was when he was the
fires.
When the fires were on, he was out in Hawaii. It's the Scotty for marketing, all that sort of stuff. Like that's larger. He's now been pegged as probably going to be one of the most important prime ministers in Australia's history.
Up there with Howard
for the work that he has done. So, and a good prime minister is like a good business person. They surround themselves with very, very smart people. They take informed advice and they make decisions. And it sounds like that's what he's done up to this point. So irrespective of my political leanings, you've got to acknowledge the work that's been done based on the whole concept of flattening the curve and how Australians, by and large, have responded and reacted to it. I think initially there was some idiots out there, when you saw the pictures of Bondi Beach of like packed and all that sort of stuff. I think people have taken it seriously, but we're doing well as a nation. So this should mean when you look back to the GFC, the remark I made earlier, running out of the GFC, one of the reasons why Australia was to be able to bounce back faster and stronger than other nations is the strength of our banking sector, the more prudent lending within our banking sector. So we didn't have a lot of those concerns and issues that you had over in the States and other areas around.
And still do have,
right?
Yeah.
So our banks are strong. Our banks are well regarded globally for that. And we've got 4 very strong banks here in Australia, plus some other major banks who are also supportive. So we will bounce back well out of this. And to that point, serviceability requirements have, up until COVID, was starting to get relaxed a little bit. It was getting a little bit easier to skewer finance if you're able to present a good package. But that sort of changed as well now. The money is still there and the money is cheap. And if you meet the serviceability requirement, it is okay. But
you're in a good position.
However, there's a lot more heightened emphasis now and obligations on mortgage brokers or lenders to say, okay, you've got this pre-approval and you had it then. Now you're buying this house. Do you actually still have a job? Or
we're starting to see, and that's fair too, because that ties in very closely to the strength of our banks.
Yeah.
You don't want them to be flippant and irresponsible about this, even at the time that if you're the one getting questioned, you might sort of song and dance about it. But from a holistic point of view, you want a very strong banking sector.
Yeah.
And for them to look at you forensically now, or back to being forensic again, I actually don't mind that because we do want a robust industry and all the way down through the property sector. Yeah.
If you shouldn't be borrowing money right now, you probably shouldn't anyway, right? Like some people can't make that decision themselves and they need to outsource it to a bank to tell them otherwise. But Steve, we're going to go to a break, but some really good chat here. We'll continue to come back around this sort of where the market will land. We'll be back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Phil Tarrant here, host of the Smart Property Investment Show. I'm with Steve Waters, Director at Right Property Group, chatting all things. It's really how this market is going to land and how you should be shaping your strategies around it. And to Steve's point, you spoke about affordable corridors. Now, I'm going to pull you up on that. What is an affordable corridor? Because one affordable corridor in Sydney is very different than an affordable corridor in Adelaide.
Yeah, very true. And that's a good point because there are different averages relevant to that particular state or metropolitan area. But for us, affordability, and you hit the nail on the affordable is to the greater mass in that particular area. So affordable also might mean $1 million property in Kirribilli because
they don't exist, mate.
Well, it's affordable, isn't it, if they do, versus, I don't know, $1 million property in Adelaide. Two totally different
things.
Yeah. So affordability for me, quite simply, is catering for the masses because at the end of the day, my mitigation is being an investor and identifying niche assets might sound good, it does paint you into a corner at the worst possible time. And my whole strategy for me personally is around not so much how the property will perform when everything's rosy and good, but how will that property perform and how will my strategy endure when we have a moment like this? And that is usually around cash flow or cash flow management. Now, I'm not proclaiming that you should go out and buy cash flow properties because, to be fair, in strong metropolitan areas, those positive cash flow properties don't exist unless you put a huge cash deposit in it. And that's very subjective as well. But one thing that we can absolutely be sure of is that many things could happen and only one thing will happen, and that this will pass. This moment in time will pass.
It will pass. And, we'll get into some of the tactics around that moving forward. So, there's a lot of big brains out there putting a whole bunch of economic statements out there to give some sense of what's going on. One of the major lenders here, I've got something from them they sent through, and I won't mention the bank in particular, but it is one of the major banks. They're saying the longer the economic and social disruption COVID-19 persists, the greater will be the risk of asymmetric effects on housing and household finances. Yeah, I get that. This bank, I'll tell you.
That's a pretty obvious statement.
Yeah, it is. Yeah. This is Macquarie Bank, by the way. I didn't want to give them a plug because I got some mortgages with them and their interest rates are high. They believe the tipping point is longer than 6 months, given the most support measures are in place or at least that long. So they're calling 6 months.
Yeah, I'd agree.
They're saying established housing sales volumes are falling sharply and will remain depressed at least until social distancing measures are relaxed. Macquarie's penciled in a 50% decline in turnover, but this may prove to be optimistic given recent trends. And what they're drawing to there, Steve, I think is the intersection between mindset and wealth effect versus the mechanics of being able to sell properties right now. So two very different things, and we'll deal with the first one first. Is about, do people actually want to sell their property right now, or they just want to hold on to it because they think they're going to get less? And the other part of it is, it's a little bit more difficult to sell a house these days because you cannot have auctions. I'll preface that with it's different per state, but auctions are not allowed in person. You can do open for inspections, but they're private inspections. So the mechanics to list and sell a house has changed, hasn't it?
It has. And funnily enough, the agents are actually okay with it. They see it as an opportunity to work with the potential buyer on a one-on-one scenario as opposed to having a group, which has its own benefits as well in terms of feed the greed or whichever way you want to look at it. But most of the agents that we're speaking to are quite okay with it. And as you said, certain states do prefer auctions. So if you take Melbourne and Sydney, they love an auction. Brisbane, not so much so. South Australia, not so much so, and so on. So the mode of sale isn't really having an impact as much as people would think. But if we come back to one of the points that report said in terms of 6 months is where we'll see that point in time. And I mentioned that it was a pretty obvious statement. And just to be clear, that's because that's when the moratorium ends. People have a get out of jail card up until that point in time. But as they say, it's all based around mobility.
Yeah.
If we get mobile again, then things will change. The clubs, the pubs, the restaurants, the cafes will potentially be full, and that economy wheel will spin, so to speak.
And it just depends how fast that will happen. So you can lift the restrictions, but how quickly will people come back to whatever normal is? And the new normal is very different. But, you look at New Zealand, they've gone from stage 4 to stage 3 restrictions. Now they're talking about moving to stage 2 pretty quickly, which will be less than here in Australia. So, and what I'm seeing and hearing now is they're talking about in May in Australia, depending on the states, they see the world a bit differently. Whether or not the state of origin is going to happen is the big issue.
That's what it's about, right? But the days are long, the years are short.
Yeah.
And I think we've got to keep that in perspective.
Yeah. So I think schools are going back at some point soon, albeit in different settings. But yeah, we'll get back to real estate happening as it used to happen. And as soon as that happens, you'll see the market dynamics, supply and demand again coming into effect. I'll continue on some of these points here, Steve. So this report summarised a scenario where housing prices fall sharply due to distressed selling is very different to modest price falls in an illiquid market due to social distancing. The former could happen under a prolonged period of very high unemployment, but this is not this bank's base case. So what they're saying then is that if there's huge unemployment, you're going to see distressed selling, versus the sort of market that we're in right now, to what you've painted in your ground truth would be it's illiquid because of the mechanics to buy and sell has been restricted. So this is where we don't know where we're going to land. It's very economic. I'm probably not qualified to talk about economics.
But I think it's a little more than that too. You have to ask yourself the question, well, why aren't people selling? Other than the mortgage moratorium, so to speak, they've got a very low cost of money. If they were to sell the property, they've still got to reside somewhere. But in a lot of cases, especially in the affordable corridors, it's still cheaper to own it than it is to rent it.
Yep.
Which is a fundamental fact. People aren't going to sell their home where they live in to go and rent where it's going to be neither here nor there in terms of their output. I also think that so if we can combine that, the cheap cost of money, the wait and see for 6 months, or probably down to about 5 months now, is just holding people off. Like, why would I sell unless they're under complete financial duress? And there are some people out there that are saying, well, there's just mountains of financial duress. We are not seeing it. And that's our piece of ground truth, if you will. We are not seeing the financial duress any more than what we saw 12 weeks ago or 16 weeks ago.
And maybe we can have a chat about that in a moment, Steve, once we get through these numbers. And I would respond to that by saying you might not be seeing it because it's probably the nature of the clients that you operate within, and they may be in industries which are in a different environment than most people who are under duress at the moment. A lot of them are in hospitality and these type of things, which...
I'm actually talking about the seller. I'm talking about...
You're talking about the seller itself?
The vendor.
Okay, you're not talking about the buyer.
No, we're not seeing any people that are saying we have to sell. Maybe there's one or two, but there's no more than usual, where people are saying we need out because we can't X, Y, Z.
You'd have to be in a lot of problems for it to impact you that much.
You are always going to be in that problem. The COVID was just the straw.
It was a catalyst to do it. So we'll chat about some of those tactics in a moment. This report goes on. Dwelling price growth has always moved closely with turnover. Yes, this is like, housing markets 101 stuff. Right?
I was trying to think of the expression.
Yeah. If that correlation continues in coming months, there will be sizable price declines. The bank's economic team is now forecasting a 5% decline in national average prices through year end.
So national average prices. So like that could take in WA, South Australia, Tasmania and the like.
Yeah.
Northern Territory.
And talk about sizable price declines. Like, I don't know, maybe it's the way I say, I go 5%, it's not that big, or people go 5%, God, that's a lot.
Well, it is, but the market is between your ears and so is value as a result. But if that's only a paper trade loss, you'll only crystallise the win or the loss if you sell.
If you sell it.
It's more about the ability to be able to pay the mortgage, hang on to the asset.
And the last point here, and this is some level of optimism, looking past the crisis, the significant easing in monetary policy, which is likely to be in place for a few years, could see a swift rebound in established housing activity and prices once the virus passes. Repayment affordability has improved markedly as interest rates have fallen. So I would summarise with those, six or so points there, that this is just supply and demand.
And the cost of money and consumer confidence, which is around employment. Because there's a few things that will eventuate in the future that not a lot of people are talking about. And the obvious one is that this will end. and obviously people are talking about that one. But there's also a massive cliff face in terms of construction, new builds, that is not happening. And whilst our population pre-COVID was very, very buoyant, and admittedly now it's stopped because the borders are closed, once this finishes, the immigration numbers will again, and once the borders are open, the immigration numbers will amplify, is my guess, back to where it was, and potentially even larger than that, because Australia may be seen, because of the way we've handled it and our low cases per capita, as the clean, green environment to which some of the other parts of the world want to live in.
It's a good point, Steve. And Bernard Salt, we've had him on the podcast before, he's the demographer. He has a concept called the Dubai effect, which is one of the reasons why, and I'll paraphrase by my memory of this concept, but the reason why Dubai is such a vibrant city in what is a very traditional and conservative part of the world is that all the riches from the nations around Dubai end up in Dubai because it's seen to be a safe and secure place to park your wealth and amplify that wealth. So Dubai is full of money from Saudi Arabia, from Pakistan, from all areas of the Middle East, Jordan, Lebanon, even moving into sort of Afghanistan and Pakistan and the subcontinent.
So it's a lifestyle.
It's a lifestyle, and you can get away with a lot more in Dubai than what you can in other parts of the world, right? So that same logic Bernard Salt talks about is that Australia is the Dubai of Asia. This is the area where wealth in Asia likes to protect and secure their income. Hence the reason why the education sector, which has been hugely impacted by this, by the way, but wealthy people in Asia send their kids to university in Australia because it's just one of the mechanisms for them to build that network and relationship down in Australia. So I completely agree with your point. I think Australia, as a result of its navigation through COVID-19, is only going to be seen as a more premier place to park your wealth and a premier place to holiday and a premier place to have a relationship with. So all that means good fundamental economic drivers for the future.
And I'll back myself on that comment, because if I combine that with the fact that construction is, even pre this, was extremely low, and the Reserve Bank even came out and said they're concerned about the lack of accommodation being built for the population growth for the years to come. Then when you overlay the COVID, which has amplified the lack of building once again, when we roll out of this, there will be an inflection point in the years to come where supply will not be there for the demand. And I'm not saying that there'll be this vertical price growth, because it doesn't happen that way. What will happen, and rentals for that matter as well, what will happen is it'll be a gradual creep, as it was after the GFC. When the GFC finished, it just didn't flick a switch and prices went vertical. There was a gradual shallowing out, and it gained momentum to where it got to in that sort of 14, 15, 16.
It's great times to be in Sydney property back then.
Well, it was. If I remember, you might have got one or two back then too.
Yeah, well, just a handful of them. But, this is this logic down to this V-shaped recovery. It's how sharp the decline is going to be. It's probably more, it's going to be a straight line down, but it's going to be steps sort of back to some level of normal. And to realise all the reasons why investment in Australia in general, but property in particular, is a good asset class. And I think that's how I would probably summarise those points. There's going to be a decline in some markets, but that might be pulled down by, that's national, might be pulled down by more negative activity in some markets, whereas some markets are going to be stable. So we need to chat about the tactics of how you should be investing in those markets.
And that's what I was just about to say, that. And it is the tactics, it's the strategy that you deploy that will hold you in good stead to take advantage of those, that moment in time for when the future does unfold. How long that is, nobody knows.
Nobody knows.
But what I am sure about, and I've always been sure about, is the control of cash flow.
Cash is king. Now, let's have a chat about tactics, Steve, but we're going to go to a break beforehand to leave everyone in suspense on the edge of wherever they're listening to this seat, baby. We'll be back in a moment.
Love property? The current Buyer's Agent of the Year and Director of Pure Property Investment, Paul Glossop, does too. And right now, he's offering you the chance to secure his best-selling book, A Surfer's Guide to Property Investing, absolutely free. Simply jump on Pure Property Investment's Facebook page, hit the message button and type Smart Property to claim your free book today.
Welcome back, everyone. Phil Tarrant, host Smart Property Investment Show. Thanks for joining us. I'm with Steve Waters, getting into, like, you're qualified to talk about this stuff. I've got this this perpetual, what do they call it? Imposter syndrome. You know, where you sit there.
That exists.
I know. You know, where you sit there talking about stuff. Like, I'm just giving.
People judging you
and judging you.
Yeah.
I'm happy to be judged. It doesn't bother me. But I am conscious sometimes, Steve, of like, you know, talking about the economy and stuff, and I sit there going, "Oh, I'm not really qualified. I probably am. Like, I'm just giving my opinion, right? This is the way I see the world."
I'd probably suggest you are.
Know, I aggregate ideas, right? Like, I don't have any more. I'll just always step one away from it. But this is just our view, by the way. Everyone that's tuning in, and I'm not big on disclaimers, but we're just having a chat. A couple of blokes having a chat about property musings about what's going on. But our intent of doing this is to making sure that you can make more informed decisions. And that's what I touched on at the intro to this podcast. So let's talk tactics, Steve. So I think we've said the long-term basis for a recovery for Australia versus other parts of the world looks okay. And a lot of that is because of where we were as a nation prior, the reasons why we're growing as a nation. And a lot of that comes down to, and you call it now, political stability. We've gone through a decade when maybe less so, but I think we've got a lot more assurance now on how we can progress as a nation in terms of political leadership. And I would also acknowledge there's always debate, but the bipartisan attitude in many ways for helping steer the nation through this particular crisis. And when often things are stalled, I think Australia has shown that when its back is to the wall, it can move quickly to get stuff done.
It's quite refreshing.
It's quite refreshing. So my point would be, can't we just do this all the time? Get rid of the red tape and the stupidity that happens sometimes around trying to pass new regulation and make it easier for people to do business or buy property, right?
Yeah, I think because when things have a degree of normality, that, you know, people love to create the drama, if you will.
Yeah. So can we please move on as a nation and not make things too complicated moving forward? Because we've shown what we can do. So it's not a bad place to be at the moment. In comparison, for some people, they're doing it tough. I acknowledge that. And I would also acknowledge and give my appreciation to the health workers right across the nation who are supporting us through this.
Absolutely.
But on that basis then, so let's talk about, what do you do about it? If you've got heaps of money right now, Steve, do you go and buy property? And if so, where? Or do we got to frame it the other way? Like, let's go back to your point before the break around cash flow, right?
Yeah. I think, to be very general, it is to each their own. But I think for someone, and I know there are some people out there saying this is the best time in eons to be purchasing.
Since the Great Depression.
Since the Great Depression. And look, for some, potentially it could be, and for others, not. Because there are many other different factors within someone's own unique financial position, not just now, but what looks to be in the next couple of years. So as always, you know, tread carefully. But if your job is secure, if your household cash flow is in check and you're not too skinny, you have enough buffers in place from a cash flow point of view, but also from a capital point of view, and you have a plan, then you may want to entertain purchasing. However, if you don't have any of those, then you've got a lot of steps to do before you can even pull the trigger on something like that. The question is where and how. Once again, everybody's different. For me personally, and I mentioned it earlier, I always want options. Options equals security, security equals opportunities. So the options for me is always around cash flow. And that doesn't mean that it's cash flow positive once again, but it means controllable cash flow relevant to the mortgage. And I want the option to create more if I have to, rather than wait on organic growth in terms of capital and cash flow. Because if you're waiting for organic cash flow, this magical inflection point where all income exceeds expenditure, and some people like to predict that at 6% per annum, and therefore in year 11, you'll become positive cash flow. I don't buy into that, because cash flow does not grow in a linear fashion. There is peaks and troughs. Today's a really good example. So I want each and every property to have a direct reason for being in the portfolio. If it's a capital growth play with skinny cash flow, I'm going to back that up, pigeon pair it with something that is more around cash flow. And that might mean I can do a renovation to accentuate the cash flow. It might mean that I can add a secondary stream of income, therefore another dwelling or multiple dwellings in the future, so that I can arrest the cash flow position, because we're always looking at it from a bottom line scenario.
So that's for people who are currently investing and have the capacity to invest. And that's, you know, we can't get into that today because everyone's circumstances are different, right? My recommendation would be, if that sounds like you and you can take action, I'd be surrounding yourself with some bright people to help you make those decisions. And that might be a property strategist, your accountant, your mortgage broker, buyer's agent, financial planner. So make sure, and just don't take one person's opinion on it, would be my point, Steve. I'd probably speak to a whole bunch of different people from different channels and make that decision.
It's very important, yeah.
But for those people who might be on the other spectrum and are looking towards, they might be in the game or thinking about getting in the game, but maybe their house foundations aren't as stable as these other people we're talking about, what would you be doing right now?
Start at the beginning, like I said, because everything is around cash flow. And I don't care who it is or who you are and how much you earn, everything is around cash flow or cash flow management. It's right up there behind oxygen for survival. And even if you're beginning today, the fundamental steps is working out what surplus you have and what your capacities are, and then finding a strategy that lets you sleep at night. That's so important, because if you pick a strategy that you're always going to have this angst and these mild anxiety attacks, then don't do it.
Yeah.
Find another asset class or something else that lets you sleep at night. That doesn't mean that whatever you do is high risk, but you just need to find your risk profile floor, if you will. But it is always around cash flow. But once again, it doesn't mean high yielding, positive cash flow properties. It's about how you strategize, create a plan, then execute the plan so that the bottom line is always in a position of livability, that you can cope with the cash flow ins and outs. It's treating it like a business. And I know a lot of people say that, but we all say that because it's
the way it is.
It's important.
Yeah. Yeah, I completely concur with you. And my personal relationship with that is that I don't like redlining. I like to know. I like to know there's buffer. I like to know there's
absolutely,
irrespective of what happens, that Phil Tarrant Incorporated is going to be fine. That's the way I like to operate.
Did you call yourself that?
No, I did. I just thought about it.
Phil Tarrant Incorporated.
I tried to.
I'm going to quickly register that name.
I just try to think of a catch-all for all the different stuff that I do. Right?
It's a pretty good way to put it.
But yeah, it's just like which is a whole bunch of different components, right? But
I would argue too that even if someone wasn't around, they didn't mind redlining before, I would argue that as people are experiencing what we have today, their thoughts are completely changing. Just as it was during the GFC, before the GFC, and I don't know if you remember, there was a lot of ads around equity mate. Take the equity out, and he was standing next to his boat or his Bentley. And people didn't worry about the cash flow management of their asset classes or even their own personal circumstances. It was just about, I can get it, so I'll spend it. The GFC pulled people up straight away and made them think once again the relevance of cash flow and cash flow management. And as we came out of the GFC, what we found was that those higher yielding metropolitan areas were the ones that led recovery. So you go back to when you first started and we were getting 7% yields in Sydney.
Yeah.
Those prices recovered quickly, more quick than the inner city did, because people once again understood the relevance of cash flow in a metropolitan area. I tend to think this will be the same equation again. The cash flow will come out on top again, like in terms of cash flow management, and people will look for those assets in whatever the asset class may be that will give them a dividend, for want of a better word, that lets them sleep at night. But then fast forward 5 years, people will forget about it again.
Yeah.
It's human nature.
And you got to remember, you got to keep that corporate memory, and embrace the scar tissue of this stuff, and
never forget.
But it was good, Steve. It was quite a long podcast. We've been at that, so I hope everyone's enjoyed that. I guess you've got a bit of time on your hands at the moment.
It's not what else doing, is it?
So no, I enjoyed that chat. There's a real mix between, and I'm going to say this, and one of the reasons why I am attracted to property as an asset class, it's pretty bloody simple compared to other stuff, right? Like, and I was sort of, I was being a bit flippant in sort of reading some of those remarks from that come out of that report, but it's like, yeah, of course, like that's the way property works, and that in many ways is why I'm attracted to it as a property investor.
Because it's not that complicated.
It's not that complicated, and it's also illiquid. It means that even though I've got a sovereign super fund, I've still got money in a retail fund. It's been decimated. My superannuation. It just overnight, it just dropped because share markets dropped, by plummeted, So there's going to be one of these points in times when, and in the future, people go, I've made X% on the share market, but it's going to be, if you did not invest on this one day in March or this one day in April, your returns would be negative forever. So I don't have the time, effort, the knowledge, the understanding, sophistication to invest in share markets because I just can't play the game. But property, it's largely simple. How many people want to buy stuff? How many people want to sell stuff? Do people actually want that? And can you actually hold on to that property? It's pretty base.
It's quite ironic that the very thing that we are taking shelter in is obviously property. It's not a BHP share. Nothing against BHP, by the way.
Yeah.
But it is our flight to safety.
Yeah.
It is our castle.
Yeah. And if you think, I guess it's connected with it, and no doubt people could argue against me, and I'm happy to have that. The government intervention in all asset classes when it comes to COVID-19 has been in property.
It's not much else.
Resi and commercial. Now, there would be an argument saying that they're shoring up business through the JobKeeper allowance, and that is intervention to support businesses, and there's breaks on payroll tax, depends where you are. There's breaks on, some other tax things. So there has been intervention in business, but nothing to the degree of property, whether you're a tenant, whether you're a landlord, or whether you're a lender.
Such as the far reach of the asset class itself. And just hopefully people don't have an element of clueless enthusiasm if they're looking at doing this, and that they take some sound advice and take very small steps. Yeah,
go and get advice. But Steve, thanks so much for sharing your insights today. Really
Pleasure.
enjoy it.
Again.
Thanks, mate. And let's get you back into this. Do this property update.
Yes.
I've been working through it. I started and then
Been an interesting conversation.
Oh yeah, it's and just as a bit of a teaser for our listeners, where I used to have some pretty high interest rates, which the stuff that I didn't fix originally, and you can go back and listen to those podcasts, which are variable. I've sort of got some wins out of that finally. They've come back a bit, but I haven't yet landed on what my net position is yet. So I try and do an hour or two every morning, and then I just get sidetracked doing other stuff. So I think it's going to be a weekend project for me, but
looking forward to it.
Quite keen to see where our cash position is. But I can report there's not 3 point something in our portfolio. Every interest rate's over 4%. So
do you know what though? You whinge about that now, but 12 months ago we would have group hugged and high-fived.
Yeah, we would have. But, so we'll have a discussion around the pros and cons of maybe fixing some stuff or how we can get those interest rates tighter. So I do look forward to that chat, but thank you. I hope you enjoy that, everyone. Remember to check out smartpropertyinvestment.com.au, social media, Smart Property HQ. Go and check it out. You can see what we're up to and what's happening in property right across the nation. Please, if you enjoy what we're doing, I don't even think Steve's ever done this, is leave a review on...
I don't know how to.
Well, just if you're listening to this on Apple, you can do it now while I'm telling you. You go to Smart Property Investment, where it says reviews, you put 5 stars on there, and you write a note that says... Philip is a genius, and I've never met anyone more informed about property in Australia.
Number one fanboy.
Number one fanboy. But please, if you are tuning into this, I get a real kick out of it. You can do that, and there's a great team here who are producing this. So, you can do that for me. It'll be great. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.